Unit 223, Portfolio Manager Operations Functions. A portfolio manager is the architect of an investor's financial future, balancing risk and reward to meet specific goals. Their key functions range from adjusting positions to leveraging technology, all to ensure the portfolio thrives in an ever-changing market. A portfolio manager's first priority is to keep the portfolio nimble so it can be responsive to market events. A position adjustment is used to fine-tune positions when there are market shifts, risk assessments, or strategic pivots. Portfolio managers might scale up a promising stock, exit a lagging one, or take profits. Then comes portfolio rebalancing. Over time, asset returns can skew from the original plan, like stocks outpacing bonds. The PM steps in, selling overweighted assets and buying underweighted ones, realigning the portfolio to the target mix that could be on a schedule or when thresholds are breached. Sometimes direct investment isn't practical, so the portfolio manager would consider a proxy instrument. It could be that an investor's interests are contrary to the goals of the company the PM has selected to place funds. A proxy has performed historically similar to the one selected. When liquidity, compliance, or regulations block an asset, a portfolio manager could use derivatives like ETFs, options, or futures to get the exposure. Another factor that portfolio managers with are capital inflows and outflows. New cash from dividends or investors gets reinvested, while outflows, like withdrawals or fees, are handled smoothly to maintain liquidity and seize opportunities. There are offensive and defensive strategies that a portfolio manager can use depending on what's happening. An offensive action that can be used is to bet on a negative prediction using short sales. When a PM puts on a short, the portfolio can gain a profit from falling prices. Also known as a hedge against risks, a short has the PM borrowing a security, selling it, and buying it back cheaper. On the defensive side, risk management helps to shield the portfolio from market shocks. When the portfolio manager uses options, diversification, or risk parity models, those measures provide a level of insurance that risks will stay reasonable and safeguard the investor's vision. After all the research, strategizing, and positioning, how does a PM know it's all working? Investment management platforms provide performance monitoring features that give screens of detailed reporting. Monitoring utilities within the platform track returns and give benchmark comparisons. Those comparisons provide attribution analysis to highlight the contributors to profitability and identify the cause of losses. Firms might use stress tests to see what could happen under worst-case scenarios. Portfolio managers use liquidity management to keep a cash buffer so there's enough on hand to cover redemptions, margin calls, or snap up a sudden opportunity without needing to liquidate positions. Portfolio managers aren't done yet. There are tax optimization strategies, sometimes referred to as tax loss harvesting, that's generally used to boost net returns. PMs use technology for algorithmic trading, real-time data, and even sentiment analysis to turn raw information into actionable intelligence. Portfolio management blends financial theory, market smarts, and cutting-edge tools. It's about adapting to today's conditions while anticipating tomorrow's. Unit 223, Portfolio Manager Operations Functions.